Are you looking to invest differently? Like, actually differently? See, the thing is that most investing channels on this platform are attempting to beat the market while investing like the market, putting their capital with the biggest, growthiest names, you know those names, the big techie firms that everyone loves. And these people somehow believe that they have an edge or that nobody has yet noticed these firms' potential. Well, newsflash, a lot of these names already comprise a sizable amount of the S&P 500 index. Everyone knows about them. I mean, that's what the market is already telling you. And while maybe there's nothing inherently wrong with investing like this, one can seldom call this finding an edge. In order to find an actual edge, you must dive deep in order to look for those names that no one else is looking at. Those names that people get nauseous thinking about, that are actually not doing as badly as people think, or names that they're simply ignoring. We'll call this deep value investing, digging through the hated or ignored names in order to find an edge. And in this video, I'll go over a simple formula in order to find those names and hence find a true edge in the market. The first step in being able to find deep value names is to obviously target value stocks. Duh. But why does value investing represent an edge? And what the heck is value investing in the first place? Basically, value investing looks at stocks that can represent a big opportunity for investors based on a company's fundamentals. It compares two metrics, the first one usually being the price of a company, and the second one being what it is that you're actually buying when you purchase that stock. For example, one of the easiest ways to think about it is by looking at something like the price to earnings ratio, the price being the share price of common stock and the earnings representing the trailing 12-month earnings of that company. This simple metric just shows you how much you're paying for the earnings of a company. By the way, if you want to learn more about our favorite valuation metric to use, make sure to check out the video popping on the screen right here. Otherwise, I'll also put it in the description. But this should make sense. The less you pay for more earnings, the better. When purchasing stocks, investors are theoretically going after those earnings. And the less they pay for earnings, well, the more earnings they get. And this is likely a reason why value investing has fared so well, at least historically. From the beginning of 1979 to the end of 2020, the top 50% cheapest stocks based on the price to earnings ratio in the US has returned on paper 13.06% versus 10.49% for the top half most expensive stocks and 12.07% for the stock universe. The question really is, why does this happen? And there's two theories. The first one says that these stocks represent a higher level of risk as they are being discounted more than their counterparts. And in the world of investing, the more risk you take, the higher the return should be. The second one says that people are overreacting to bad news and are not pricing a potential mean reversion in the future. After all, a lot of these companies lie in less than desired industries such as energy, industrials, and consumer discretionary. Personally, I think it's a little bit of both, but investors need to be wary that value investing is already riskier since it shows higher volatility and tracking error when you compare to the benchmark. Moreover, a lot of these companies have a legitimate risk of going bankrupt, which is obviously not conducive to higher returns if these risks actually materialize. Not just that, but remember, we are going deep into value investing. We are making an even more concentrated bet, so we want to dive headfirst into these risky names in order to potentially garner higher returns. So adjustments are in order. The most obvious adjustment then is to make sure to target cheap companies that show quality characteristics. They are paying back debt, buying back stock, growing their earnings, demonstrating operational efficiency, because naturally these stocks are less likely to go bankrupt, while at the same time they are cheaper than the market. It's almost oxymoronic that these stocks actually exist, stocks that are cheap but also have displayed superb quality, and yet they do exist. It's also the case that quality stocks have also been in the market over the long term. Naturally, stacking the quality characteristic on top of a value portfolio can enhance risk-adjusted returns. A blog post by Nicolas Rabener, which I'll link down in the description, tells you the whole story. Historically, combining high quality and value has given you similar returns to just buying pure value in the US. Additionally, both of these strategies trounced buying low quality value during this time period. Interestingly enough, buying value and high quality has actually beaten buying pure value in Europe and Japan, while risk-adjusted returns are better when combining high quality and value in all three samples. So far in our deep value investing formula, we've figured out the foundation. Buy cheap, and within the cheap, find the highest quality stocks. But in order to go deep, we must be intentional with our level of conviction. Reducing the number of stocks and rebalancing frequently is one way to warrant that we actually have a sizable exposure to whatever factor it is that we're targeting. After all, if you believe that buying the lowest PE stocks can get you higher returns, you would want the cheapest PE stocks in order to juice up those returns. So instead of buying the 1,000th cheapest stock, you buy the cheapest stock in the market. Now, this is not to say that buying one stock is the way to go, and not at all. That's not what I'm saying. Ideally, we reduce idiosyncratic risk to a manageable level, but after that, it's about making sure that we are targeting the cheapest stocks possible. In the paper Fund Concentration, a Magnifier of Manager Skill, the author finds a convex correlation between concentration and excess return. Managers that are good at their job achieve explosive returns the less holdings they own, and managers that underperform also have explosively bad returns. Concentration is like a magnifier. Whatever characteristic or return you have, once it's concentrated in a small number of stocks, the more of that you'll get. But if we're formulating a deep value investing strategy, well, it's obvious you have to go, well, deep and concentrate the thing by targeting the top number of cheapest stocks so that you go where the juiciest, highest expected returns are likely to be according to this formula. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.